Okay. Um, okay, so let's look at the required. So the required says calculate the taxable income of JJ manufacturers for JJ Manufacturers Limited for the year of assessment ending 30 June 2022. Okay, so before I read the required, I just want to go through this approach. So there's an approach in which we have to basically look at questions, and even the scenario, even the required. So I'm just gonna go through it. This approach is called the MM approach. So what happens is, so the first thing is perspective. You have to know what person you are. So in tax, it's very important to know what person you are. So are you a natural person? Are you a company? So that's very important to know who you are. So what company's tax you are doing, or what like whose tax you are doing basically. So the person is very important. So that's one of the things that we have to take note of. The second thing is the date. So dates are very important. And what dates, I'm gonna teach you like a way to read like scenarios, especially the dates. I suggest from now on you read the dates with reference to the reporting period. So you have to know the year of assessment. That's very important. And then every date from there on, you are going to read with reference to the year of assessment, so that you get more information from that date, because dates are very important in accounting and tax. Yeah. And then after we know, basically, we have the perspective. Yeah, the next thing is to identify. So identify whether this thing is an inclusion or is a deduction. Yeah, so it's an inclusion or is a deduction. And basically implication is, now that we know that there's an inclusion or deduction, how do we include it or how do we deduct it? Yeah. So you will see going forward, I'm going to use 4 categories for inclusions and deductions. So we are going to have inclusions, exempt inclusions. So exempt inclusions is exempt income. Ne? Then we have deductions and exempt deductions. Ne? So exempt deductions, you know them most probably as limitations on deductions, but they're actually exempt deductions, right? Then, yeah, that's all I wanted to cover for now. So let's move to the exam. Let's move to the exam, to the required. So the required says calculate the taxable income of JJ Manufacturers Limited for the year of assessment ending 30 June. Now, the first thing I said, what's very important, the JJ Manufacturers, right? So do you see that JJ Manufacturers, firstly, we see that this is a company, right? It's a company, right? And we are calculating the taxable income. So it's very important also to know what tax you are doing. So on perspective, they also add tax. So it's a person, it's the date, and the tax you are doing. So whether you are doing VAT, or you are doing income tax or dividends tax or donations tax. So it's very important to know what tax you are doing before you even start with the question. So it's taxable income, firstly, so we know we are doing income tax. So the income tax of what company? JJ Manufacturers for the year of assessment ending 30 June. Now we know the year of assessment is ending 30 June. So when did it begin? It began on the 1st of July, 2021, and it ends on the 30th of June, 2022, right? That's the year of assessment. Then it says start with profit before tax. So it says start with profit before tax. So what does that mean? It means that you are starting from the accounting perspective, right? So don't forget, as we are doing the question, you have to remove things that are in accounting but not that are not in tax. So yeah. Then we continue. It says provide brief reasons for any amount mentioned that has no effect on the taxable income. Do you see that they said also provide brief reasons? So you provide brief reasons as to those amounts that have no effect. So you have to include everything here. So we have to discuss everything, even those that we won't even like show the effect. So you just write that transaction and then show the zero and then give a reason for the zero or the slash or whatever you wrote there. So that nil that you wrote, you have to give a reason for that. That's what they mean. Now that we are done with the required, you can start with the scenario and start answering the question. So how are you going to start this question? you're going to firstly have your profit before tax, right? So profit before tax amount. So you're going to firstly have your profit before tax amount. I'm sorry, I'm just looking for the page where I wrote it. Okay, so you're going to start with the profit before tax amount. With regards to the amounts, I'm just gonna type them down. I'm just gonna type the amounts down. So yeah. So I hope you have your question paper with you. Yeah, I wasn't able to scan it. I don't have the question paper with me electronically, and I don't have the solution with me electronically. So please listen very well. I'm going to go through the solution, but I'm going to do it like very slowly. So please take notes as I'm doing it. So when we start, we're going to start with the profit before tax, right? Profit before tax amount, and the profit before tax amount, it's 4,394,750. That's where you start. So you're going to write profit before tax, right? Profit before tax, and then you're going to type that amount. You're going to write that amount of 9,343,94750. So that's where you start, right? That's where you start. You start with the, okay, let me just illustrate it here properly. Okay. Okay, I think this will work better for illustration purposes. Okay. Okay. So what do we have? We firstly have our profit, right? Profit before tax, right? Amount of how much? We have a profit before tax amount of how much? Of four. So it's 4,394,750, right? That's the profit before tax amount, right? That's where we start. Then let's read the question. The question says JJ manufacturers. So we are JJ manufacturers. That's the text that we are doing, right? And that's the company. It says it's a South African resident company, okay, with a junior, and we already know that. Their policies to defer their tax liability where possible and necessary elections have been made in terms of section 84E and paragraphs 65 and 66 of the 8th schedule of the Income Tax Act. So let me just explain that whole part. So what do they say? The first thing is say their policy is to defer their tax liability. So there are certain sections standard in the tax legislation that allow you to defer tax liability, right? And what are those? Those are deferrals of what? Of recoupments, right? So that paragraph section, that section 84E and paragraph 65 and 66 of the 8th schedule, they're talking about the deferral of recoupments, right? And 65, it's specifically involuntary. So it's for like when you are disposing of an asset involuntarily, or 66, it works. So 66 is when you have a replacement asset, right? So if that, so it's two things. So if that asset, like you dispose of it involuntarily, so maybe due to fire or something like that, yeah. And then that's 65. Then 66 basically is so 66 is when you have a replacement asset. So that's when 66 works. So it's for replacement assets. I'll continue. So it says the following is an extract from the statement of comprehensive income for the year ending 30 June 2022 for JJ manufacturers. Okay, let's continue. It says, please note JJ manufacturers is not a small business corporation for purposes of section 12, section 12E, right? Okay, we know that. And now, where is that thing? So let's talk about the small business corporation. where do we consider small business corporations? Only when we are doing allowances, right? So they are telling us here that when you're doing allowances, do not consider this thing as a small business corporation, right? Yeah. Now we can continue. It says all amounts exclude VAT. Okay, so we know that all amounts exclude VAT, but they didn't tell us about whether this company is a VAT vendor or not. So we will assume JJ Manufacturer is a VAT vendor, right? Then we're starting then with the question. So profit before tax, we wrote it down. We start with notes. Cost of sales, number one. Included in the cost of sales is the following transaction: cost purchased in transit, not sold, not included in trading stock on 30 June 2020 to the value of 200,000. Now let's talk about this. There's a, I don't know, you guys like you must have covered it, but there is a section, there's a section 24F, anti-avoidance, that says that if you have stock that you purchased, if you have stock that you purchased, and it's not in your premises, so you purchased it and it's not in your premises, then you have to remove, you have to you have to add back basically that so what they say, you have to remove the deduction. And how do you remove that deduction? By adding it back. So we have to add back this 200,000. I'll go through it again. Normally, trading stock, what do you do? When you buy trading stock at the beginning of the year, you're gonna what? Include it in gross income, right? And then at the end of the year, what do you do? Exclude closing stock, right? But think about it properly. If you don't have that stock with you right now, it won't be part of your closing stock. So do you see that the amount of closing stock that you are adding back will be less, right? Because that stock is held by the supply, right? Like in this question, right? Then that means that you have to add it back according to section 23F. That's the anti-avoidance. So this 200,000, because it's stock that the supplier has, so it's in the supplier's premises, you have to add it back. That's the first one. So this 200,000 you add it back. So that's the first transaction. So we are going to say cost of sales, right? We will reverse the cost of sales amount with 200,000, right? Then we move on to dividend income. So let's move on to dividend income. So they say the dividend accrued from companies listed on the JSE. So these companies are local companies, right? So this is local dividends, and local dividends are exempt. So that's a rule. Local dividends are exempt, right? But you see in accounting what happens. In accounting, they recorded the dividend income. So what do you have to do? We have to subtract the dividend income. So going to subtract the dividend income, 40,000. Okay. Then we move on. Let's move on to the next one. So the next one on the list is rent income. So let's read it. It says JJ purchased a commercial building for 2.1 million on 1 October 2001. Now, I'm going to teach you how to read dates properly now. You are supposed to actually say JJ purchased a commercial building for 2.1 million this year, right? He purchased it this year. Do you see 1 October 2001 is this year, right? Which was rented out to a tenant for. And do you see that this year, what is this year? Let's check this October. So it's July, July, August, September, October. So do you see like it's 3 months in the year. So he bought it 3 months in this year, right? And we know with commercial buildings there are allowances, but what do you know about those allowances? Already we know that those allowances, you do not apportion those allowances. So it doesn't matter when we actually purchase this thing, you don't apportion the allowances, but I'm going to get there. So how you read the date, this is how you read the date. So JJ purchased a commercial building for 2.1 million on the 1st of October 2001, which is actually 3 months in the year of assessment, right? Which was rented out to a tenant for 15,000 per month from 1 November, which is 4 years in the year of assessment. Do you see? It's 4 years in the year of assessment. Now, when did we start renting this out? 4 years, like 4 years have passed in the year of assessment, right? So do you see that we didn't rent this out for the entire year, right? So we rented it out for how many months? Let's count: November, December, January, February, March, April, May, June. So it's 8 months, right? Then if you say 8 times 15, what do you get? You get the 120, right? And do you see that the 120 is the same as the 120 rent income on the table? So if you can page back and you look at the table, you will see that it is that 120 there. Do you see it? So do you see for the rent income, you won't do anything because the tax treatment and the accounting treatment is the same. So what are you going to write there? Just gonna say rental income, right? And we are going to write a reason as to why that thing is zero, because you remember we are going to write zero there. So we're going to give a reason as to why this thing is zero. So it's same treatment. That's the reason. So same treatment. So that's the reason. I'm not gonna type it. I don't have space here. So the reason is it's because of the same treatment. Same treatment between accounting and tax. That's the reason why you don't do that. So in accounting, that recognition of 120,000 is the same as in tax, right? So we can move on. Let's go to commercial building, right? So they said the building was initially completed during April 2006 by the seller who sold the building to JJ. So now you know that we have to we have to what? We have to calculate what? Allowances on the commercial building, right? However, before we start calculating the allowances on the commercial buildings, we have to remember one thing. When did the standard of so when did this section 13 queen start? So when was it in effect? When was it put in effect? It was on 1 April 2007, right? And you see that this thing is 2006. So that means that you will not put allowances for it because that standard wasn't in effect yet. Yeah. Can continue then. So no allowances for this commercial building. So we're going to say you can type, you can write the allowances, right? And then obviously not allowances, I mean. So section 13 queen, yeah, section 13 queen deduction, because an allowance is a deduction. So an allowance is a deduction because it's reducing the taxable income. So section 13 queen deduction or allowances for commercial buildings, whatever, as long as they can see what you're saying. And then what's the reason for it not being there? The section, right, was not in effect. So the act was not in effect. The law was not in effect. That's the answer. So it was not yet in effect. That's the answer. And that's why it's zero, the allowance. Yeah. You remember the question said give answers for if there is no values. So that's why you have to write it down. And then we move on. It says the lessee has to effect certain improvements to the building in terms of the lease agreement, for which is for 10.5 years, right? So do you see now we are in a lease agreement, right? So what are we in this lease? We are the lessor. Do you see that they are still talking about this commercial building, right? We are the lessor, and the lessee has to effect certain improvements to the building in terms of the lease agreement, which is 10.5 years. The improvements were completed on 1 May 2000, so 1 May 2022 to the value of 55,000, right? The contract stipulated 70,000 as the value of the improvements. The present value discounted at 6% amounts to 30,000. Okay, so let's do this one. So do you see that? Firstly, this is what is this? This is a lease improvement, right? And this is a lease improvement where we are the lessor, right? So lease improvement, so you can start by typing lease improvement. So lease improvement, and who are we? We are the lessor, right? So, and what does the section say? So what does the paragraph say about the so what does paragraph H say? So paragraph G say about lease improvements. What does it say? It says you are going to, if there's a stipulated amount on the contract, ne, you are going to use the stipulated amount. Ne? So if there's a stipulated amount, you use the stipulated amount on the contract, or you're going to use the value of that the value of the improvements. So the first thing you have to look out for is if there's a stipulation in the contract. So do you see that the contract stipulated that it's 70,000, right? So you're going to use that 70,000 even though the improvements were 55,000, right? Because the section says you use the one that's stipulated in the contract, right? Then that's the first, so that's the first thing you consider for lease improvement, right? So you're going to have your 70,000 here, right? But you are not done. You're not done. Do you see here? Let me show you here. You will see in most of your solutions, so your answers, your memos, they're going to have basically 3 columns. We're going to have this column here, then they're going to have a column for calculations, right? And then here they're going to have a column for answers, right? 3 columns. Please also structure your answers in the same way, and always write everything down. Do not think in your, like, think on the paper. It's better to think on the paper and then scratch it out. But do not make the mistake of just thinking without writing down what you are thinking. Write everything down and then scratch after, especially calculations. Okay. So, okay. So here, so this 70,000 is in the middle column, ne? Yeah. So that 70,000 is on the middle column. Okay. 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 So what comes after here? After the lease improvement, if you are a lessor, right, and you're improving basically you're improving that leasehold, that property, SARS is going to give you what? It's going to give you a relief, right? SARS is going to give you a relief, right? It's called the relief for lessors, right? And it's in paragraph, I think paragraph H. Yeah. So they are going to give you this relief. They're going to give you this relief, right? And what is this relief equals to? This relief is equals to the amount. So the amount stipulated in the contract, right? Minus the present value discounted at 6%. I hope you wrote that down. So it's the contract stipulated amount minus the present value. That's the amount for the that's the relief for the lessor. Ne? And I'll give you a reason why, as to why they are giving a relief to a lessor. Think about it properly. Ne? If let's say you are a lessor and a lessee improves your building, do you see that as a company you didn't spend anything? As the lessor, you didn't spend anything, right? However, you are being taxed. As a lessor, you didn't receive anything. I mean, you didn't receive any cash, you didn't receive any money, you didn't receive anything. However, there's this inclusion of 70,000 that you are given, right? The reason why they're given the relief is because while the lessee is still still residing in that property, you are not yet entitled to those improvements. Why? Because the lessee is still in the premises. So even here, do you see that the lessee is going to be in that premise for 5.5 years? That's why there's a relief for the lessor. That's the reason for the relief. Yeah. And the relief, we said, it's the contract amount minus the present value. So it's going to be 70,000 minus that 30,712, right? And the relief you get there, so the relief for the lessor there, the relief amount for the lessor is, the relief amount for the lessor is 39 Okay, relief is a minus. So the relief is 39 288. Yeah, 288. Yeah, that's the relief. And then what are you gonna write here? So for the total column here for the lesser, so what's the total for the least improvement is 70,000 minus this 39,228, right? So 70,000 minus this 39,228. I think it gives you. Let me check on the calculator. I didn't actually do this one. Okay, let me check on. So it's 70,000 minus 39,288. Okay, it's 30,712. Okay, yeah. Now we are done with that number three. I hope you got that the number three part, because I believe in the subs they're going to ask you similar questions. In fact, they're going to give you the same question as so something similar like this, because most of the marks come from taxable income. So it's very important to actually note down everything that I'm saying. Then we move on to number four. So number four is depreciation. So depreciation, firstly, we're gonna add it back, right? So we're gonna add back the depreciation. So depreciation, going to add it back because that's an accounting amount. Going to add back that total depreciation of 260, 250. So 260, 260, 250. Yeah, yeah. So the first, or we add, yeah, the first thing we add the depreciation, yeah. And then go back to number four. So let's look at number four. It says JJ acquired the following assets during the 2022 year of assessment. So it acquired it when? This year, right? Acquired it this year. Then two delivery vans were brought into use for the purposes of trade this year, right? 1 April 2022. So that's this year. And how many months into this year? So let's count July, August, September, October, November, December, January, February, March, April. So it's actually 9 months into the year, right? So they brought it. So they brought these two delivery vehicles 9 months into the year, right? And then they each cost 210, right? So what are we going to say? So we're going to have the allowance for that. So that's a section 11E allowance. So section 11E. So you can write it anyhow. So you can say section 11E or wear and tear, whatever, just to illustrate to them what this thing is. So I just call it a section 11E deduction. And then you're going to say this 210,000 times two, right? Because it's two delivery vehicles. And then you're going to divide it by 4 to get the allowance for the year. But don't forget that this is wear and tear. So you have to apportion it for the number of months in the year. So you're going to say 210. So 210 multiplied by 2, right? Divided by 4 times, you used it for 3 months, 3 over 12. And that gives us so this is the as part of the deduction is 26250. That's that's basically the wear and tear. We can continue. So we move on to the machine. So a machine new and unused acquired from an unconnected person and brought into use in the process of manufacture on 1 June 2022. So they brought it into use 11 months right into the year. So that's when they brought it into use this year, new and unused. And then the original cost of the machine was 330,000, right? JJ incurred delivery charges amounting to 6,000. That's the cost to the asset, right? So cost to bring the asset into location, that's the delivery cost. And installation cost amounting to 40,000. That's another cost to deliver the asset to the condition and location intended for management. So those costs are added to the cost, original cost of the machine, right? So you're going to take the 330,000 plus 6,000 plus 40,000. So plus 40,000, and that gives us what amount? Let me just check here. Okay, and that gives us 76,000, right? And what are we gonna do with that? That machine, what is that machine? What section applies to that machine? It's section 12C, right? Because that's a manufacturing machine. So section 12C is for manufacturing machines and what? And plants. But don't forget also aircrafts. Aircrafts are also in here. So it's manufacturing plant, not building, plant and machinery and aircrafts. So that's section 12C. And what does it say? It says new and unused, you have to use 40%. We know about that. So it's multiplied by 40%, that amount, which gives us so the deduction, which gives us that amount, 150,400, right? Can continue. It says, so 4.3, it says a clock machine to be used by the factory employees, which costs 6,900, right? This clock machine was brought into use on 1 June 2022, right? So do you see that section 11E applies on this one, right? Wear and tear, right? However, do you see that this particular asset, this clock machine is worth less than 7,000, right? And according to section 11E, if that asset is worth less than 7,000, you include the total amount. So 6,900 as the deduction, the allowance, right? And that's number 4. Yeah, that's number 4. We are done with number 4. We move on here to 5. 5 is restraint of trade, right? So the first thing we're going to do is we are going to put back that 25,000, right? That amortization, because we are doing tax now, so accounting rules don't really apply here. So amortization, you will continue this amortization, restraint of trade. So I'm just gonna say restraint of trade. So restraint of trade, and then what is the amount there? It's plus 25,000, right? Because this we are doing tax, so accounting rules don't apply. We go to the restraint of trade. So it says after one of the engineers at the plant resign, JJ entered into an agreement with him on 1 March 2002. So that's this year, right? He entered into agreement this year. In terms of the agreement, he is not allowed to render his services in Gauteng to any manufacturer during 5 years. During the 5 years, as compensation, he was paid 500,000 on 1 April 2002, right? And it says the accounting policy that JJ follows stipulates that the amount must be written off based on the number of years of the restraint of trade, apportioned monthly. So do you see that this part, so the last sentence of the accounting policy, that's not really relevant because that's accounting and you already removed it. So let's just look at that part on. So let's look at everything except the last sentence, right? So what do we have? We have a restraint of trade, right? And who are we? We are the business, right? So we are paying this restraint of trade, right? So it's supposed to be a deduction, right? It's supposed to be a deduction to us. So restraint of trade deduction, but you know that the restraint of trade deduction is also limited, right? So it's limited to what? Lesser of what? Lesser of 1/3. So you're going to say lesser of what? The restraint of trade over 3, right? Or the restraint of trade over the number of years, right? So which one will give you a lesser amount? It's obviously the one with the number of years, because the number of years here are 5. 5 over 3 is more than 5 over 500,000 over 3 is more than 500,000 over 5, right? So we're going to use the 500,000 over 5. That's the that's the that's the restraint of trade. So restraint of trade, right? And that amount is 100,000. Yeah. We move on. So that's the restraint of trade part. So number six is part of the depreciations. So for accounting, we are already done with number 6. Let's continue with the tax rules. So JJ's existing manufacturing building was proving insufficient for its future plans, and the board of directors accepted a proposal by the general manager to replace the old factory. Do you see what's going on? They are saying the old building, the existing building, this old existing building, they want to replace it with a new building, right? So what section applies here? It's that paragraph. It's section. What section applies? It's section 84E. So the one that they told us about. So if you can page back to where we started the question, did you see they said there are policies to defer their tax liability where possible, and necessary elections have been made in terms of section 84E. So this is where that section actually applies. Why? Because we are using paragraph 66 of the 8th schedule, because this thing is a replacement asset. They are replacing, so they are simultaneously disposing and replacing of an asset. That's paragraph 66. And then 65 is when you dispose of that asset involuntarily. So you don't like it was not really, you didn't volunteer to do it. So it was involuntary, right? Like a fire broke out, you had to dispose of it. Ne? That's when 65 applies. But 66 is if there's a replacement asset. So there's a replacement asset, so 66 applies. So we can defer the recoupment, right? Let's continue, and I'll show you how you actually defer the recoupment. So let's start. It says the old manufacturing building. JJ sold its old manufacturing building on 15 December 2001, right? So it sold it during this year, right? For 6.3 million, and incurred the following with the sale. So agent's commission of 210 and valuation fees of 120,000, right? Then JJ originally erected the building, so the old manufacturing building themselves, and it was used wholly for manufacturing purposes, right? They started construction on 1 January 2001 and brought the building into use on 1 January 2002. So what's the important date? The 1 January 2002. That's the important date. Why? Because that's when it was brought into use. Then the cost of construction was 3.1 million. Included in the cost of construction was a canteen, 9% of the total floor space. So it's equal to 9% of the total floor space at a cost of 300,000. Yeah. Then they say, okay, then they say the building was improved in January 2014 at a cost of $1 million. And the improvements were additional space for machines costing 940,000, and 60,000 was to improve the canteen. The improvements were finalized in August 14 and immediately brought into use. Okay, so where do we start with this? Ne? So every time when you're doing it doesn't matter. So when you're doing anything with assets, the first point you start at is the allowance. The allowance it like you got. So let's start with the allowance. This year's allowance. So let's firstly get the cost of this. So what section applies? It's section 13, right? Because this is a manufacturing building. So section 13 applies, right? And it the use, we started using it after 1 October 1999. So which means we're using 5% from there onwards, right? And then what's going on? What amount are we going to use? We are going to use this 3.1 million. Take note, do not minus the 300,000 of the canteen. I know the canteen, do you know why you don't do that? Ne? It's because of this rule. So there's a rule in section 13, and this rule is very important. Ne? So please note it down. Section 13 for manufacturing buildings, it says this allowance is only, it's only considered when the business, so that manufacturing, that manufacturing building is wholly or mainly for business purposes. Do you see that in this case it was mainly, even though it wasn't wholly, so not all of it was for business purposes, but 91% of it was for business purposes. So yes, you do the allowance for it, right? If it wasn't, ne, if it wasn't, then there is no allowance. So you never apportion this allowance. You get that clear? You never apportion this allowance. It's either it's there or it's not there. So what you want to do, you're going to take this 3.1 million and multiply it with 5%, right, for this year. Now, before you do that, don't forget these allowances, it's 5%, right? And 5%, how many years does 5% last? It lasts for 20 years, right? So you have to also take note that, do you see that the allowance that you are actually allowing for this year, this is the last allowance on the building, because the building was brought into use on January 2002. So the reason why I'm saying this is because it's mainly because if it was, let's say this year of assessment was 2023, right? That would mean that so if it was 2023, that would mean that there's no there wouldn't be any allowances for this building, because you would have been done, because you finish 20 years, right? So this was the last allowance. So you're just gonna say 3.1 million multiplied by 5%. That's your allowance. So that's your section 13. So section 13, that's section 13. So it's just section 13. And then, so we say 3.1 million multiplied by 5%. That gives us 155,000. Okay. Then, so that's the allowance firstly for the building. Now let's go to the improvement. They say the building was improved on in January 2014, right, at a cost of $1 million, right? Now, do you see that these improvements are to improve that building, right? So they are actually part of that cost, right? So those improvements are going to receive the same percentage, right? Same percentage. So I'm just gonna say section 13 deduction 2. So also for the, going to say section 13 deduction, and 5% also of $1 million, not 940, of $1 million. Like I said, you never apportion. So you use the total 1 million. So 1 million, right? 1 million multiplied by 5%, and that gives us 50,000, right? And then now we are done with the allowances for the building, right? We can move on now. We can move on to the first thing we do. So this asset is disposed of. What's the first thing you consider when you're disposing of an asset? The first thing you consider is the recoupment. You consider the recoupment, right? Let's consider the recoupment. And what is the recoupment? So what is the formula for a recoupment? It's selling price limited to cost, right? So selling price limited to cost, right? So let's look at the selling price. The selling price is 6.3 million, right? However, do you see that what this asset actually cost us was 4.1 million, the 3.1 and the 1 million for the improvements, right? So what's the selling price limited to cost? It's 4.1 million. That's the first thing, right? So 4.1 million. And then it's selling price limited to cost minus what? So selling price limited to cost minus, so it's minus allowances, I get minus allowances that you already claimed at this point, right? So what's the allowances that you claimed for the 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 building? It's everything. It's everything, right? So it's that 3.100000, right? Then plus what? So it's 3.100 plus what? Do you see? Do you know why we are putting in that 3.1 million? It's because, like I told you, that that building, the allowances, like it was the last day this year. It was the last year this year for the allowances. So we claimed allowances for the entire period, right? So that's why we're putting in the entire amount. And then plus what? Plus the allowances that you got from the building from for this improvement from 2014, right? So you're going to count 2014. So it's yeah, that you got from no. They said they improved it on July 2014, right? So which means you received them 2015, because the year of assessment, which means the first year of assessment was 2015. So it's 2015, so 15, 16, 17, 18, 19, 20, 21, 22. So it's 8, right? So it's 8. So you're going to say that 50,000 multiplied by 8, right? So 50,000 multiplied by 8, that gives us 400,000. So it's 400,000 plus the 3.1 million, right? Those are the total allowances that were actually allowed on this asset. And what is recoupment? Recoupment is you are recouping allowances that you haven't yet that basically you haven't yet claimed. They want them back, right? So you're going to say that 4.1 million. So that's the selling price limited to selling price limited to cost, right? Minus the 3.5 that you got for the allowances, and that gives you 600,000, right, for recoupment. But you remember what we said? We said the recoupment is deferred, right? So what you do after you did that calculation, so this calculation that we did, you are just gonna save this amount like on the side. You're not gonna yet write it down, because why? This recoupment is deferred, which means there's a certain way in which we have to include this recoupment, right? So we don't include it yet. Let's move on to the new building, because we are going to include it with the new building. So, but before we move on to the new building, after we do the recoupment, right? What's next when we sell a building? It's CGT, right? You have to calculate its capital, because the capital gains tax, right? So, and what is capital gains tax? What is the formula for capital gains tax? The formula for capital gains tax, right? I'm just gonna continue here. The formula for CGT. So for the formula for capital gains tax, what is it? It's proceeds, right? And the proceeds are 6.3 million. It's proceeds minus what? Proceeds minus recoupment, right? So this it's 6,300,000, right? 6.3 million. This 6.3 million minus what? Minus the recoupment. The recoupment is 600,000 minus 600,000, and that gives us 500 and so that gives us, let me just write this one down, because this is a very long calculation. So it's 5.7 million, right? And then we move on to the base cost. So the base cost, right? So what is the base cost? So the base cost is the cost of the asset first, right? Which is the 4.1 million, right? So the total cost of the asset, including the improvements, right? And why now, before we continue with the base cost, now when you're calculating the base cost, do you see that this building was actually brought into use on 1 January 2002, right? And that's after the valuation date value. Yeah. So you don't consider the valuation date value rules. Do you see? That's after. So you just considering what we bought, so the cost. So it's that 4.1 million. And that 4.1 million, you add the selling cost, right, to the base cost. That's the rule. So you add 210,000 plus 120,000. So you add those to the base cost. That's the That's the rule, that's the principle for base cost. And then the amount that we get is now, what is the formula? It's base cost minus what? Allowances, right? So for base cost, we got 443 44, so it's 4.4 million. Yeah, we got 4.4 million 30,000, right? 4,430,000, that's what we got. And let's look at the total allowance. We did calculate the total allowance. You remember, right? We calculated total allowance, and the total allowance was 3.5, right? The total allowance was 3.5 million, right? So we're going to say that 4 million and 4,430,000 minus 3.5 million, right? Minus 3.5 million, and that gives us 900. So 930,000. Yeah, that gives us 930,000, right? So what is the total amount for the what is the capital gain? So the capital gain is 5.7 million minus 930,000, right? And that's 400. So that's the capital gain. And in this question, it was the only capital gain. If it wasn't the only capital gain, you're just gonna put it on the side and do other capital gains and then add them up together with last year's previous. If there was a previous capital loss, you're gonna add it back in this calculation. And then what we do is we're gonna take this amount and multiply it by what? 80%, because we are an entity. We are not an individual. If you're an individual, we multiply it by 40%. But before that, you have to remember that annual exclusion. But we are not individuals, we are still a company. So it's 80%. I'm just gonna remove this amount. There's this calculation here and leave this amount here. Yeah, and that's CGT. That's the CGT part. We can move on. So new manufacturing building. So it purchased a vacant piece of land on which they plan to construct a factory. The land was purchased on 15 January 2021. So this year, right, for a cost of 800,000. The construction of the factory commenced on 1 March 2001. That's still this year, right? The factory was completed on 1 September 2001. That's still this year. The total cost of 1.7, so 1,750,000, right? Then they say the building was brought into use in the process of manufacture on 1 October 2001, right? So 1 October 2001 is the important date. Then, okay, what are we going to do? Firstly, we have this manufacturing building, right? What do you want to do? We want to calculate the allowances on this building. So it's section 13 allowances, right? So before we do that, we know that allowances are on the building. So you're going to say 1.7 million 500 minus 800,000, because land is not depreciated, minus the land. And then from there on, you after you minus the land, so it's 950,000. What you do is times 5%. So normal allowances times 5%, and that's equals to 47,500. Now don't forget, we have to now go back to this recoupment issue. We have this recoupment issue that we still have to solve, right? So what does the principle say of deferral of recoupment? What they are saying is this is why this thing was put into place. Just imagine if, let's say, you dispose of an asset involuntarily, what's going to happen? SARS is going to say they're going to charge you a recoupment, right? And what does a recoupment do? It increases your, do you see it increases your tax liability, right? Because it's an inclusion, it increases your tax liability, right? That's why they are like, because it's not your fault, it is an involuntary one. You can include that recoupment, like as you include the allowances for the new asset. Do you see? Because the allowances are going to minus the recoupment because it's not your fault, right? And for replacement one, they are saying, oh, we see that this money, like the reason why you sold this asset was not for a profit. No, you sold this asset because you wanted to buy another asset, right? You immediately use that money to buy another asset. You see, that means that you don't have that cash on hand. You don't have reserve, like you don't have cash reserves. So what do? They give you this relief. So this thing is a relief, right? They give you this relief of saying that you can defer, so you can take out that recoupment as you take out the allowance. That's the main principle. Take out the recoupment as you take out the allowance. And what does it mean? You take out the recoupment at the same rate as the allowance. Right now that we know that the allowance rate is 5%, so you're gonna say 600,000 that we got for the recoupment times 5%, and that's the deferred recoupment for deferred recoupment for this year. It's the 30,000. I hope you got that. Okay. Um, that's the recoupment, and then we move on to in the next part. It says JJ rented a manufacturing machine for use in the new factory. The rental agreement stated the following: the term of the lease says 10 years. Date is 1 October, so it's this year. They got it this year, you see, and the monthly rental, they say it's 18,000, right? So they said it's accounted for as part of expenses. So it was already accounted for. So all you're going to say, they're going to say um, monthly rental or lease payment and zero. And the reason why is it zero is because it's the same accounting treatment as like tax treatment, right? And then we go to that lease premium payable. Do you see that they said it's not accounted for yet, right? So we don't need to do anything for accounting. In terms of accounting, all we need to do is include it in like according to tax rules. So what does the rule for lease premium say? It says you're going to take the lease premium that they paid divided by what? The term of the lease, right? But it's limited to 25 years. So if it was more than 25 years, it was going to be 25 years. Yeah. It was going to be 25 years. So okay, I got a question from Lungits. It says, why didn't you add the recoupment? So what I added here is the deferred recoupment. So it's only 30,000, right? Not the total recoupment. Because like I said, this is a replacement asset. So what tax wants to do is they want to give you a relief, right? Because this money that you got from actually selling this asset, you don't have it with you. So you can't pay them tax, right? You actually bought that asset with that money. So what happens is, now that we know the allowance of the new asset, right? The allowance of the new asset, that allowance, you are just going to use the rate of that allowance to also like release the recoupment. So you're going to release it at the same rate, right? So because it's 5%, you're going to use 5% even here. Yeah. Then going back to lease going back to lease premium. So lease premium, what you do is we know that it's divided by the lease term, right? Limited to 25 years, right? So you're going to say 150,000 divided by 10, right? And that gives us 15,000. So this lease premium, wow, what happened? We are the one that paid it, so it's 15,000, right? And then they told us that the factory contributed 30,000 per month to the net accounting profit since it was brought into use. So this statement, this statement is just here to confuse you, even though this thing must be included in the income, so in the profit that we got, in the accounting profit. So you don't do anything on this thing, right? So we are going to continue more. I'm going to finish. So in the next session, I'm going to finish this question, and I'm also going to do a vet question, but in the one in AO2, just explaining deeply. So if you have any questions, please, do you have any questions before? Do you have any questions? Any questions? Okay, no questions. Okay, okay, guys. I'll see. Okay, let's see. Okay, why didn't we apportion the lease premium? You mean okay? Yeah, yeah, yeah. It should be apportioned. Yeah, it should be apportioned. You are right. It should be apportioned. The lease premium should be apportioned. Yeah. Yes, you're right. It should be apportioned. Yeah. Then so it's going to be 150,000 multiplied by 9 over let's see October, yeah, 9 over 12, and that gives us 112500. Okay. Okay, for the dividend income, don't forget that SARS does not do anything with the dividend income, right? Like it's exempt. So you have to remove that amount. That's why we don't do, like, we don't multiply it by 80%. You're just removing the accounting effect on that amount. That's why. Okay, there's a message from Pule. So it says, please really explain the trading stock in transit. Okay, so let me go back to the trading stock in transit question. Okay, so when they say trading stock in transit, they say transit, firstly, I it means that the order has been processed by the supplier and the supplier has begun the dispatch process with the courier or shipping company. So do you see that when they say in transit, is the main thing they mean there is that the goods are still with the supplier. That's what it means. The goods are still with the supplier, right? And what did I say? Let's go back to trading stock. Normally, when you have trading stock, when you buy trading stock this year, the year that you buy it, what you're gonna do, you are going to say trading stock deduction, all of it, the entire amount, right, that you purchased it with. Then at the end of the year, what you're gonna do, you are going to add back the closing stock, right? However, remember, your closing stock will be based on the stock that you have on your premises, right? And that stock that's held by the supplier, it's not in your premises, right? So do you see that closing stock amount is going to be less? That's why they said if it's held by the supplier, so in transit, that's the anti-avoidance. So section 23F is anti-avoidance. It says add back also that amount that's in transit. So that's with the supplier. I hope I explained that one. Okay. Um, okay. All right. With regards to the video, can you will see I got you are all in the WhatsApp group chat, so everyone who attended this session, can you please text me personally, so Tshireletsho personally. You will see the two coordinators. Text me personally or Temba personally, Sibongiseni personally. um Send your email addresses and your name, please, and then we'll send you the link to the video. um Thanks. Is there any other questions? Any other questions before we close up? Okay. Um, okay, I'll see you. I'll see you later then, 5 o'clock for the next session. See? Thank you. Thank you.